The excess business loss limit, also known as Code Section 461, puts a hard cap on how much in business losses you can use in a single year. The limit changes every year because it's adjusted for inflation. And even though this is a standard tax calculation, failing to apply it correctly can raise a red flag with the IRS. Quick housekeeping note before we jump in. I'm a former IRS agent, but I'm not giving tax or legal advice here. Everyone's situation is different, so make sure you check with your own tax or financial advisor before making decisions. I'm here to explain how the excess business loss limitation actually works, why it matters, and how it ties into things like net operating losses and capital gains, along with some business tax planning strategies. Think of the excess business loss limitation as a brake pedal. It slows how fast large business losses can be used, so in some cases those losses can't completely wipe out your other income, such as W-2 wages or investment gains in a single year. You can still use business losses to offset other income, but it's only up to a certain limit. For 2025, that limit is $313,000 if you're filing single, or $626,000 for those of you married filing jointly. Any loss above that amount is excess. By the way, as of 2025, the excess business loss limitation is officially permanent. You might have heard that it was scheduled to go away after 2028, but under the One Big Beautiful Bill Act, this limitation is here to stay. There's also another important wrinkle to be aware of. Starting with your 2025 tax return, you'll have what's called a specified loss, which is an excess business loss that was disallowed in a prior tax year. That specified loss gets added to the current year's total business deductions. For example, that means that any excess business loss that you generate in 2025 will show up as a specified loss on your 2026 return. Okay, let's break down how excess business losses work. When you're figuring out your excess business loss, not everything counts. That includes your wages, like if you're paid through your S Corp. Also, net operating losses, the 20% qualified business income deduction, and losses from selling or exchanging capital assets. In fact, the excess business loss calculation happens before the qualified business income deduction. Speaking of capital assets, losses from selling them aren't included in your total business deductions. Gains from those sales can count, but they cannot exceed the smaller of these two amounts. The capital gains and losses tied directly to your business, or capital gain net income. Now, you might be wondering, does my business file this or do I? The limitation applies at your individual level, not the business level. So it's all about how it affects your personal tax return, not the return for the business. For partnerships and S Corps, that means the limit is applied to each partner or shareholder individually. But this limit only comes into play after you've applied three other tests. First, outside basis. How much do you actually have invested? Next, at-risk rules. How much could you lose if the business fails? Finally, passive activity rules. Were you actively involved or were you a silent investor? Think of it like a series of filters. Only the losses that make it through all three get to the final excess business loss test. There's a special note for farmers. If your farming losses exceed the threshold, you have to apply the excess business loss guidelines before you carry any net operating losses back 2 years. And if you have both farming and non-farming losses over the limit, the threshold amount gets applied to your farming losses first, to the extent you have a net operating loss. All right, let's pause for just a moment and zoom in on the passive activity loss rules. There's something called the grouping election, and it plays a big role here. What this election does is help determine whether your business losses are treated as passive or non-passive, and that distinction really matters. When you make a grouping election, you're allowed to combine multiple businesses, and in some cases, certain rentals like short-term rentals, into one bigger activity. The goal is to see if, as a group, you were materially participating. Why does that matter? Because even if you weren't active enough in each business on its own, grouping them together might push you over the line. Once you meet material participation, those losses become non-passive, or what is called active losses. Now, here's where the strategy gets interesting. Active losses can be used right away to offset other active income, like W-2 wages. That sounds like a win, and often it is. But there's a trade-off. Those newly active losses now get tested under the excess business loss limitation. In other words, grouping can help you unlock passive losses, but it can also increase your excess business loss. So the big takeaway is this. How your losses are classified, passive or non-passive, matters a lot. The grouping election can be powerful, but it needs to be handled carefully because it affects when you get to use your losses and how much the IRS will let you use in a single year. So what actually happens to an excess business loss? That disallowed amount gets converted into a net operating loss, or NOL. You can't carry it back to prior years, but you can carry it forward indefinitely and use it in upcoming years under the NOL rules. And if you're wondering where all of this shows up on your tax return, This calculation is done on IRS Form 461 called Limitation on Business Losses. Now let's connect the dots between an excess business loss, a specified loss, and a net operating loss. The whole point of this system is to control how fast business losses can be used, making sure they're first matched against business income instead of immediately wiping out non-business income. Here's how the cycle works. If your total business deductions exceed your business income by more than the annual excess business loss limit, the excess portion is disallowed as an excess business loss. It carries forward to the next year as a net operating loss and is labeled as a specified loss. Starting in the following year, that specified loss gets added back into your total business deductions. That means the same loss may have to go back through the excess business loss test again year after year. Each year, the IRS essentially allows you to use your total business income plus the annual excess business loss threshold amount. That combined amount is the slice of your business deductions that gets released. Any remaining loss that doesn't make it through stays trapped as a specified loss and carries forward to try again next year. And even when a loss clears that gate, it still isn't unlimited. The NOL steps in and can generally offset only up to 80% of taxable income in a year. Before we move on, I do have one tip here. Documentation matters. Keep solid records for the year the loss is created and for every year it's carried forward. Carry forward losses are something the IRS looks at closely, especially because people tend to lose track of them over time. Really quickly, I want to show you how the new excess business loss calculation works now that a specified loss has to be included every year. A quick disclaimer. These are simplified hypothetical numbers just so you can see the mechanics clearly. Let's say you're filing your 2026 return in 2027 as a married couple filing jointly. You have $1 million in wages, a $1.874 million specified loss carried over from 2025, and a couple of other hypothetical numbers. If you look at your screen, you'll see that in 2026, $712,000 of losses are allowed. The remaining $1.662 million is carried forward as a specified loss into 2027. Without the specified loss retesting requirement, you might have been able to use more of that 2025 loss to reach the full 80% NOL limit, or $800,000. Instead, the retesting requirement slows the use of that loss even more. Because the IRS caps how much business loss you can use each year, tax planning becomes important, and it's usually a matter of timing. Learning how to manage that timing is what separates a good business tax plan from a great one. With taxes, timing is a strategy. When your income and losses hit your return can completely change the math on how much you actually owe. And that's a detail you don't want to get wrong. For example, if you ignore the excess business loss limitation when you're making estimated tax payments or filing an extension, you could be in for some serious surprise penalties and interest. Now let's get tactical. Here are a few business tax planning moves, all based on timing, that can help you manage excess business losses more strategically instead of just letting the IRS call the shots. First, accelerate income. If you already know you're going to hit the excess business loss limit this year, bringing income into the same year can actually help. You're basically filling up the loss cap so more of your losses get used now instead of being pushed into another year. Second, defer expenses. On the flip side, you might delay certain discretionary expenses or deductions into another year, especially if you expect higher income or lower losses later. That way, those deductions are more likely to be usable. Third, there's depreciation. This is a big one. Deductions like bonus depreciation can sound great, but taking a massive write-off all at once can create a loss you can't fully use. In some cases, it makes more sense to opt out of bonus depreciation and spread the deduction over several years. That way, the tax benefit lines up better with income you can actually offset. And finally, coordinate non-business income. If you're sitting on something like a large capital gain from selling stock, recognizing that gain in a high loss year can be a genius move. It gives those losses somewhere to land right now, allowing you to use them immediately instead of letting them get trapped by the IRS limits. It can be the difference between paying 20% in capital gains tax or paying 0% because your business loss wiped it out. Strategic timing might allow you to use losses much sooner. But be careful, sooner isn't always better. You have to consider your overall tax situation. For example, if you expect higher tax rates in the coming years, those losses may actually be more valuable later. That's why business tax planning is about strategy, not just the math. By the way, I mentioned bonus depreciation earlier and why it's not always a win to take it. The IRS treats it as automatic, so you actually have to elect out if you don't want it. If you want to go deeper into when bonus depreciation helps, when it actually hurts, and exactly how to opt out, check out the video in the upper left of your screen. I'll see you in the next one.